At the same time the Fed's hiking rates, you have a severe degree of monetary tightening going on through a stronger dollar, which makes things more expensive overseas. 40% of corporate revenues are tied to international sales. Earnings are still too high, so earnings are going to have to come down because of that. Corporate profit margins are going to contract sharply. Asset prices haven't adjusted for that yet. And then this very sharp increase in yields is going to put a massive amount of pressure on households, businesses, corporations, et cetera. 20% of the Russell 2000 index are what we call zombie companies, and they require debt in order to pay the debt they have. So if they can't issue debt at cheap levels and refinance debt at cheap levels, they have real problems. So there is a significant risk of a financial event occurring as we get into 2023.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you here at the end of the week for another weekly market recap with my good friend Lance Roberts. And what a week it has been. How are you, Lance?
Hanging in there. It seems like I've been saying that a lot lately, right? Just hanging in there, trying to get through the week.
It does. Well, you've been telling us you were down in your bunker. You're in a new environment right now. Is this what it looks like down in the bunker?
In the bunker. This is in the bunker. We are now, I've got my beanie weenies. I've got my gold coins, my ammo.
You're 3 miles under the earth.
Exactly.
Okay. All right. Well, I'm going to apologize to everybody in advance here. We are not going to have a short video today. Just looking at the list of big topics to chew through with you here. Everybody make some extra coffee, strap in. I'll try to keep this under an hour and a half. I'll cut it off there arbitrarily if I can, but there's just so much to go through. All right. So the big development of this week, another down week in the markets. We'll talk about the specific market action in a second, but we got to really talk about what happened this week with the over in the UK with the Bank of England, because that really threw the markets into a tizzy, but also raised some very big questions about, is this the kind of systemic breakage that's going to force the central banks to change policy, and will their policy shifts even be able to stop the problems that are forcing the central banks to potentially change? So people are asking, is what's happening in the UK going to be coming here to the US at some point?
Right.
So I guess, Lance, real quick, just give some general market commentary, and then we can kind of deconstruct for folks exactly what happened this week, because if you weren't reading all the articles, it's a little bit hard to understand what went on there.
Yeah, so there was actually a couple of things, and actually, if you want kind of a quick overview about financial instability, I actually wrote an article for MarketWatch this week. And particularly focusing on kind of talking about what happened with the Bank of England and why this is important, because one of the things that I've been arguing now for the last 6 months is that this whole inflation fight by the Fed is fine and dandy, right? There's inflation, you're going to hike rates to kill inflation. And while that's great, and if you're operating in a vacuum, that'll work, right? As long as everything else is status quo, you can hike rates, you can kill inflation. But the inflation spike that we saw was because of all this monetary intervention. It wasn't because of strong economic growth. So in that environment, inflation, and as you and I have talked about, Adam, this year, is that inflation, the best cure for high prices is high prices. Inflation is going to come down regardless. If the Fed left rates at zero, you would still get rid of inflation over time, because that monetary, it's kind of like talking about the rabbit through the python, right? As that monetary stimulus finishes going through the pipeline, inflation will come down, economic growth will slow. And that's what we're seeing with economic growth this year, right? We've had 2 negative quarters, quarter 3 is barely positive. And, that's just kind of the environment. So what does this have to do with Bank of England? Bear with me, I'll get there. But
okay.
This is all tying together, right? It's like those comedians that you got to go through the story to get to the punchline. Just bear with me, the punchline's coming. So, the point about this is that we've been arguing that as long as the Fed wants to fight inflation, that's fine. But as soon as there's a hint of financial instability, that inflation fight goes out the window, because financial instability is a much more insidious risk to the economy and to the outcome of inflation, which becomes rapid deflation if you have a credit-related financial event in the markets. And there are numerous things that are now piling up, along with higher interest rates, that suggest the risk of a financial credit-related type event will occur in the markets sooner rather than later. Now, the Bank of England is exactly a case in point of likely what we're going to see in the US. So the Bank of England last week had to reverse course on Wednesday and start buying bonds because they were doing QT and hiking rates just like the Fed, right? We got to kill inflation. We got all this inflation going on. We've got to hike rates and do QT. That's awesome. They tend to forget that pension funds and the economy and everything else is heavily levered against low interest rates. So pension funds borrow collateral for the pension fund, and they borrow that on margin. So when interest rates go up and asset prices come down, they are forced to sell that collateral to meet margin calls. And the risk and what the Bank of England had to bail out last week were these pension funds that were basically facing potential. Now, we didn't get there, but the risk was if they kept doing what they were doing, these pension funds would become insolvent because of the margin calls. And so the Bank of England had to step in to stop basic financial instability caused by higher rates breaking something within the pension fund system. Also, 24% of UK mortgages are variable rate mortgages, and a bunch of those mortgages are about to start resetting to much higher rates. Of course, that's also potential risk here for defaults and foreclosures and all these type of things. Now, why is that important? Because the US is the UK on about 5 times of, about 5 times of size in terms of scale. Our pension funds are huge. They do exactly the same thing. They borrow collateral on margin. Yes, margin debt has come down from the recent peak, but it's still at some of the highest levels that we've seen historically. So there's a lot of margin debt in the system. Households are heavily tied to credit card debt, variable rate debt, et cetera. Let me give you a few examples from just this past week. CarMax on Wednesday announced earnings. And of course, CarMax sells used cars, right? This has been one of the big stories of the year is used car prices going through the roof. CarMax just reported an absolutely terrible quarter. Sales down 8%. Outlook was absolutely devastating. Stock fell 20%. Nike reported earnings talking about, I guess people can't afford $400 tennis shoes anymore. They reported a very big slowdown in sales, a big build in inventory. So you are starting to see those early events coming into the market of that slower consumer, slower risk in the markets. But of course, also on the other side of this is all of this debt, right? We have a lot of collateralized loans, leveraged loans, zero down mortgage loans, all those type of things that are all going to be affected by higher rates. Now, so on Wednesday, I wrote this article for MarketWatch talking about financial risk. And in that article, we discussed 2 items in particular. One is the year-over-year increase in the rate of the dollar. The other is the year-over-year increase in the rate of yields. Both of those are at some of the most significant increases on a year-over-year basis ever in history. And what's important about these 2 charts in particular is that every one of these spikes historically have been tied to an economic crisis, event, bear market, recession, et cetera. And so the purpose of this is that, again, as I said earlier, if the Fed is hiking rates in a vacuum, fine, that's one thing. But at the same time the Fed's hiking rates, you have a severe degree of monetary tightening going on through a stronger dollar, which makes things more expensive overseas. 40% of corporate revenues are tied to international sales. Earnings are still too high, so earnings are going to have to come down because of that. Corporate profit margins are going to contract sharply. Asset prices haven't adjusted for that yet. And then this very sharp increase in yields is going to put a massive amount of pressure on households, businesses, corporations, et cetera. 20% of the Russell 2000 index are what we call zombie companies, and they require debt in order to pay the debt they have. So if they can't issue debt at cheap levels and refinance debt at cheap levels, they have real problems. So there is a significant risk of a financial event occurring as we get into 2023. Does that about sum it up for a punchline?
It does. All right, so I'm wrong. We're done. We're ending it here. Lance just described everything. All right, no, so okay, there's a number of different parts of that answer that I want to dig into here. Let me go back to the Bank of England just for a moment, and I want to just lay out a little more clearly for folks exactly the progression of what happened, because I think it's really important to understand the elements of it, because as you sort of mentioned, you know, there are elements that may very well make their way back here to the U.S. and certainly to other countries as well. So you know, basically the Bank of England, like the Fed, has been in inflation fighting mode, right? So it's been raising rates. It hadn't started quantitative tightening. It hadn't reduced its balance sheet yet, but it had announced that it was going to, and it was days away from beginning to implement the first round of actual quantitative tightening, and it had been telegraphing to everybody what it was doing. But then we had the new prime minister elected, and because politicians, you know, want to look like that they're doing something about the problem, they announced a stimulus package. It's called the mini budget, I believe, and this was something like 65 billion pounds worth of debt-funded tax cuts. So they were gonna lower people's taxes, but they were gonna cover that shortfall by injecting, you know, 65 billion pounds worth of stimulus in the economy using debt. And this is why policy really matters. This is why Lance and I, you know, talk about what our policymakers are doing, because what you had here is you had the Bank of England shoving its foot on the brakes, right? Raising interest rates, trying to slow the economy. And then you have the politicians there deciding, nope, we're actually going to put the stimulus in here, which is basically putting their foot on the gas, right? And the bond market there, bonds in the UK are called gilts. You know, rates had been going up along with the interest rates hikes that the Bank of England was making, but also because folks were getting more nervous about the uncertainty. And when this mini budget proposal was announced, they just said, wait a minute, you know, clearly if you're doing that, you're going to restoke inflation. You're basically undoing everything that the Bank of England's trying to get under control. We want to be compensated for this increased risk because we're now realizing you're maybe not going to be successful in fighting inflation. And the UK has got a worse inflation problem even than we have here in the States. And so gilt rates started going up, and then it created that vicious cycle that you were talking about, Lance, where the pension funds there had you know, bought or borrowed collateral or bought collateral on using margin, and as the value of the gilts or the bonds that these pensions owned were dropping as interest rates were all of a sudden spiking, they were getting margin calls, right? And they were beginning to run out of other collateral to sell to meet the margin calls, and they had to start selling their gilts themselves, which added to the downward, you know, pricing pressure on gilts, which then created more margin calls for these guys. So basically the Bank of England was looking at a contagion. It was saying, look, there's going to be a systemic cascade coming down from this, and gilt prices are going to go. I mean, they were a few months ago, they were 1%. At this point, they were like 5 on their way to 7. And so the bank said, look, we got to step in. We got to start buying gilts here to stabilize prices. So that's what the Bank of England did. And so they basically abandoned their tightening efforts and said, you know what, we wanted to do quantitative tightening, but we can't. We got to go out and start buying these gilts in the open market.
By the way, real quick, that's
yeah.
also why that is also a reason why you saw that big drop in 10-year Treasury yield prices this past week on Wednesday and Thursday. There was a big drop in Treasury bond prices, and that was because the Bank of England was selling Treasuries at the same time, because they were selling collateral to raise cash, and they own a lot of U.S. Treasuries as well.
Right, which is great to point out that this whole system's interconnected. So we got to be careful, because what one country decides to do can quickly spill over into another. Treasury market being basically the biggest market out there, and what happened in the UK, a smaller country, you know, definitely impacted the U.S. Treasury market. So you know, what's important to note about this is, you know, it's an open question right now. Can England continue trying to get inflation under control, or are their hands tied here? And what's kind of crazy, in my opinion, is that because all this was sort of triggered by this mini budget stimulus package that was proposed, Prime Minister hasn't backed off on that.
Right.
She created this massive instability shockwave, and yet, as of right now, she's still planning on go ahead with this, right? So, England might just have to accept the fact that they're going to have to live with inflation, high inflation, for the foreseeable future right now, because essentially what they went through just said, hey, our system's too unstable for us to do that. Now, if they get their policies aligned, and who knows, hopefully maybe as the dust settles, there's a better path out of here. But right now, it's very unclear whether the UK is going to be able to actually pursue the aggressive plan that it had to get inflation under control. So obviously, a lot of people are asking, okay, well, is this a preview of what's coming to the US? I think a lot of people were saying, and actually what was crazy is when this was going on in the UK, prices were rallying in the markets here in the US. And I think that was because the market was saying, oh, well, maybe what's happening there means we're going to end quantitative tightening here sooner. And hey, that's good for stocks, which is kind of moronic, because you shouldn't look at that and say, oh, that's good for anybody. This is a complete desperation move that the Bank of England is having to come in and do. And like I said, it didn't solve anything. It just stopped the hemorrhaging for the time being. And of course, we've seen saner thinking prevail, and markets have been trending downwards ever since. But it opens a lot of questions, Lance, about, will the Fed be able to continue to do what it needs to do to get inflation under control? Or will this, systemic instability that you're talking about force its hand to have to change course before the job is done, just like we're seeing happening in the UK right now?
Well, the answer is yes. And it was interesting. So I posted that article with Market Watch on Wednesday, suggesting exactly that fact, is that the inflation fight is all fine and dandy until something breaks. And again, the inflation fight's kind of moronic to start with, because it's not real inflation. But it was very interesting, because just yesterday, Charles Gasparino, I'll just read a tweet from him here real quick. He says, scoop, that's a two-part tweet, so bear with me. Federal Reserve officials getting increasingly worried about financial stability as opposed to inflation as higher rates begin to crush bonds. Several big investors are telling me. Fed growing worried about possible Lehman moment with a 4% Fed funds rate as bonds and derivatives tied to them are crashing. Given the enormous debt issued in just the past 3 years at super low rates, a Fed watcher told me the UK intervention was not a one-off, and the same systemic risk could happen here, which might cause the Fed to pause. More coming on Fox Business. So that is exactly the crux of my article that I wrote on Wednesday for Market Watch.
Okay. All right. I want to get into that in just a second, based on a conversation I just had on my channel with Danielle, where she talked about an interview that she did with Lacey Hunt recently that talks about Lacey's thoughts about what happens if we get systemic instability. Real quick before I get there, I do just want to go back to one thing you mentioned. You talked about what these higher rates in the UK are doing to the housing market there, because there are so many mortgages that are variable. It's actually worse than you portrayed. So it's true that 25% of mortgages in the UK are variable, but the remaining 75%, they are 25-year mortgages, but they are fixed only for the first 2 to 5 years.
Right.
Then they become variable after that. And what most people do is you then go get another 25-year mortgage at the new rate. But those folks until recently, like most folks that have a mortgage right now, have it at like a 2% rate in the UK. It's now basically headed to, it's been at 6 recently over the past couple of days, right? So mortgage rates are basically tripling, right? That's the new reset. And so you have all these mortgages, 75% of them that are somewhere in their, near the end of their 2 to 5 year fixed rate, that now have to re-rate, right, at a much higher rate. I was just watching a video this afternoon of a news show there where they were talking to the audience about this, and a woman said, actually, I've been trying to get a new home. I'm a first-time home buyer. I was quoted a mortgage rate of 4% 2 weeks ago. They just called me up and told me that the mortgage company is now canceling that offer. They're not going to extend at that rate anymore. The new one is 10.5%. And they're saying I should take it now because it might actually go higher even from here, right? Hopefully things come down a little bit as the dust settles there. But I mean, imagine that going from a 2% fixed rate when it comes up for renewal, and then you're at 10 plus. I mean, it's like Armageddon to the housing market there if that's indeed what goes down.
Well, look, I mean, you're gonna see the same thing here. And, it's interesting. I get a lot of people calling me right now going, what, mortgage rates are going up, should I buy a house? I'm like, yeah, if you can find the right house at the right price, you buy it. Don't worry about the mortgage rate, right? Because just, if the mortgage rate was 10, right? Get it out at 10. If you get the price for a deep discount, right? If you're buying a house for the right price, go get a 10% mortgage. That's fine, because when rates come back down, you just refinance it at a lower rate. And we forget, Adam, we talked about this before. We forget that, back in the 90s, a 10% mortgage was a good deal, right? It was like, that's sweet. I'll take that all day long.
In the mid 80s, you had a 15, 16%
yeah, one. And so, but the point here is that high rates are good for bringing down. I posted a couple of charts on Twitter today about the housing market. I run an index called the Total Housing Index, which looks at the entire life cycle of building a home. So it starts with permits, then it includes the permitting process, the construction process, and then the sales of new and existing homes, right? So it combines all into one index. That index is dropping sharply, right? Because, not surprisingly, there's a direct correlation to 30-year rates. So as mortgages go up, nobody wants to buy a house. That's good, because that's going to get rid of some of this overvaluation, and house prices. Those will come down sharply over the next few months. Again, that's 40% of the housing, basically of the inflation calculation. So when you, and rents, by the way, we were talking last week about, I wouldn't touch multifamily apartments at the moment from an investment standpoint, because there's such an oversupply of multifamily apartments. So many between those opportunity zones, which were really terrible ideas in a lot of cases. People are just throwing up apartments just anywhere they could find a spot, call it an opportunity zone. That won't work out well, but it increased a lot of supply. And then you had just the supply of everybody else building multifamily homes to get onto the rental thing. There's a huge oversupply of multifamily properties. And we talked about this with commercial property back a few years ago, that in the city of Houston, as an example, we had 6 million square feet of vacant office space. And, everybody was hoping that was going to fill up. And then we had the pandemic, and now nobody's coming back. So these buildings are just still empty, and they're not ever going to fill back up again because of the work from home hybrid thing, right? So the same problem's happening with multifamily. Rents are already starting to come down. Supply and demand, right? It's just a function of how it works. You build too many properties, prices are going to come down. We're seeing those prices come down. As interest rates go up, housing prices will come down. All that feeds into the inflation calculation. So by the time we get to this point next year, inflation will probably have come down more than people expect. And again, if the Fed's operating in a vacuum, great, maybe they stop hiking rates. But between that, the dollar interest rates, and what's happening, in the rest of the economy, I don't think they get that far.
Okay. God, I'm going to talk more about that too. I got to go back up to the Lacey comment for a minute, and then dial through a couple of different data points, and then get back to exactly what you just said there. Okay. So financial instability, you think that could be the thing that pushes the Fed to reverse policy course, perhaps before it's got inflation down to the area it wants it to be. Go ahead.
Let's stop something real quick. Okay. We need to make a clarification here about what we're talking about. So again, let's talk about inflation. The inflation we have right now, let's just talk about that in a vacuum, right? Too much money, not enough, too much demand, too little supply, we have inflation. Okay, that's fine. And that, again, high prices will cure high prices because it slows economic demand. We have demand destruction because of high prices, right? You and I agree with that.
Yep.
So that's just the process of inflation. The problem with financial instability is that it's insidious in the standpoint that it basically crushes the economy. I mean, there's actual, inflation's one thing, right? That's just high prices. I can't afford it. I don't buy as much. And so inflation comes down, we have slower economic growth. A financial event is insidious because it crushes economic activity, right? People lose their houses, people lose their businesses, people lose money, a variety of, they default, bankruptcies. I mean, right. Just 2008.
Yeah, and it can break the system, right? Like in 2008, the concern was like the banks might not work, right?
And that event, see, while the Fed's focused on this inflation, the reason I say that the financial instability is more important to the Fed is that if you get financial instability, you have no inflation. You have inflation today, you have financial instability, you have deflation tomorrow.
Yeah,
it will happen that quickly. There will be no inflation if you have financial instability. And that's why it's such a fear of the Fed to have financial instability, and why, and again, going back to our point, this is why they will come off this inflation. But right now, there is no financial instability. Volatility is still below 30. Credit spreads aren't rising sharply. They're up a bit, but not dramatically to a level that you have to be concerned about. Employment's still fairly low. Jobless claims just hit a new low last week. So there doesn't seem to be any concern of financial instability right now. But as we just saw with the Bank of England, there was no financial instability last week in the UK. The problem with financial instability is that it literally shows up overnight.
Yeah, it's like a landmine.
Yep.
Yeah, you don't know it until you step on it. Okay, great clarification. You're making it really hard for me to get to my questions, which I'm going to keep driving to.
I want to set you up because now because I know what Lacey Hunt said, so just go.
Okay, great. So, and then I've got some other ones that build on this too. So, when Danielle and Lacey were talking about this, she raised the question about what about financial instability? Because Lacey was saying he thinks the Fed is actually doing the right thing right here in the near term. It's doing what it needs to do. And she said, yeah, but what about, the threat of financial instability? And he basically said, we've got tools to deal with that the Fed hasn't been using. And he talked about the discount window.
Yeah.
And he said, look, we've morphed in terms of the way that we deal when problems come up is we bail everybody out, right? And that's what 2008 was. And the discount window, and you may know more about it than I do, Lance. I can only understand it from a very high level, but it's basically a process of taking a firm that's in dire straits and helping it resolve, right? And resolving might be, we're going to go out of business. We got too overexposed. We're too in trouble. But it keeps the companies from just dying overnight, right? So you don't have kind of like a layman-like just sort of meltdown that then creates a bunch of cascading ripple effects or shock waves that bring other players down. It slows the process down. It makes it much more gradual and much less disruptive. Companies hate doing it because it's incredibly, public and shameful for the egos of everybody involved. But from a health of the system standpoint, it seems like a much better way. It really actually it's a way to enable the creative destruction of true capitalism, which is okay. We got this big bank that got overextended. Rather than bail out Citibank, we're going to basically slowly dismantle it and sell its assets off in an orderly manner. And we're going to let other players who were better actors step in and take over their business. And basically the prudent are going to get rewarded and the folks who got overextended are going to take their lumps, but it's not going to break the system down. So Lacey said that, and he said, I'll just tell you one other thing you said and let you react to both. He said, for other reasons I won't get into in detail right now unless you want to. He said, it may actually get harder for the Fed to justify doing QE going forward. And we may be in a situation where the Fed decides it's going to stop that policy. And the new easing just might be a pause, which is we stop tightening, but we're not going to go forward to further easing. Anyways, I'll leave those two, big statements there and let you react to them.
Yeah. So the discount window, you're right. It is a policy tool that can be used and it is there. And again, and companies are remiss about using the discount window specifically because it has a stigma tied to it. It's kind of one of those things where if you go to the discount window, everybody in the whole universe knows immediately you've got trouble.
Yeah.
And so, that has a lot. I mean, maybe you don't have a lot of trouble. Maybe it's just you've got a liquidity crunch that you're just getting through, but nobody wants to go that discount window because as soon as you do, your stock price is going to drop by 20 or 30%. So
right. And then people don't want to lend to you. And
exactly.
Yeah.
So that's like the last step that anybody will take. Because of that. So again, the problem with that, of course, is that by the time you find out, and he's right. I mean, look, he's very right about the discount window, and this can be used to help kind of smooth out the process. The problem is twofold, really, in my opinion. That's just my opinion, and I am not one to argue with Lacey Hunt ever. But he and I agree that deflation's the big risk here. So I mean, this is deflation's coming. Just hold on to your hat. But the problem with this idea, and again, we've been doing these stress tests for banks ever since the financial crisis, right? And we go, oh, these banks are healthy, they've got lots of capital. Well, the reality is you don't know, because we repealed mark-to-market accounting back in 2009, and we've never reinstated it. So a lot of these assets, these mortgages, loans, et cetera, that are on the books of banks are marked at 100 cents on the dollar, and people haven't made a payment on them in 2 years because of the moratorium on mortgage payments or rental payments or whatever, right? So there's potentially a lot more risk on the books of banks than we actually realize. And again, since they're remiss about going to the discount window, by the time that we understand that there's a real problem, it may have the Fed may be able to unwind them orderly. That's great. But the impact to the market may be substantial because of the market figuring out that there's a potential risk through multiple. It won't be just one bank. It'll be, if we get to this point, it'll be multiple banks. And so again, I'm not saying, and because we won't, we won't have a 2008 financial crisis because of the way we do things now. We don't have subprime debt. We have other problems of debt, but we have a much more rapid response to bail stuff out, i.e. 2020 is a good example, right? Checks to households, QE, 120 billion a month, et cetera. We've now, and for better or for worse, and I would say more for the worse, MMT is now a thing. It's now a policy tool for the government, right? So again, we get into another crisis. It doesn't matter whether it's a Republican or a Democrat. It's not going to matter. The first tool they're going to go to is, hey, let's send checks to households. So that'll come again. Put moratoriums on rental, even though putting moratoriums on rent payments destroy the landlords that own those rental properties that depend on those incomes to meet their mortgage obligations. We'll go back to doing moratoriums. So, we now have got all these new tools to work with. Every time we have a crisis, we're going to go right back to kind of the same toolbox. But this makes things long-term worse. It's going to continue to erode economic growth, continue to widen, the wealth prosperity gap. There's a consequence for all of these actions that we do, but we're going to keep going back to that same well, over and over again to stemmy, these recessionary drags we have in the economy. And again, as you and I have talked about before, recessions are a good thing, because they get rid of excesses. We just don't want to go through the pain for them.
Right. Yeah, it's a society, we've lost our tolerance for the healthy part of the boom bust cycle. And I think that's why we're faced with now the bigger problems we have right now, is because we didn't let the malinvestment clear out, and it's all just built up now. And now the system's kind of beginning to buckle under all of that. So, okay. Anyways,
real quick to his last point, whether or not the Fed will do QE again. I think he's got a good point that, the efficacy of QE is getting less and less. It's taking more and more QE to get the same net effect out of the markets, right? Because the only reason to do QE is to lift asset prices, right? So that's why we do QE, that boosts consumer confidence. But as we know now, that shoved all the wealth to the top 10% of income earners. And yes, it increases consumer confidence, but it never really boosted economic growth to any great degree. We just kind of trudged along at 2%. So the efficacy is taking, so my point is taking more and more and more QE to get the same amount of growth out of the economy. So, he's got a point that the Fed, probably shouldn't do more QE, but I just knowing the Fed and again, knowing the government, I think their first option is going to be right back to dropping rates to zero and doing QE because that's what worked before.
Yeah, well, we'll see. And the Fed has been lucky this time in the sense that it's really benefiting from the currency is benefiting from the dollar milkshake theory, right? So the dollar's remaining strong. But let's go back to the UK for a minute. They have all the issues we just talked about, and plus their currency has been getting taken out to the woodshed by the dollar, right? And if we didn't have our unique currency situation right now, I mean, domestically, we've seen our purchasing power really erode here, but it would look a lot worse if we didn't have the world reserve currency right now.
Oh, absolutely. Yeah, I was gonna say, I mean, just gonna, where do you want your money right now? Do you want it in the sterling or the pound, or do you want it in the dollar? I mean, and that's the problem, is that the US dollar has become a vacuum cleaner. Nobody wants to have their reserve currency in their currency. It's all flowing into US dollars.
Right, which in many ways then makes the plight of these countries even worse, right? Yeah. All right. So I wanted to raise this because I don't have the answers here, but the certainties of the game, I think, are becoming lower everywhere, right? Like, will the central banks be successful in what they're doing? I think we're all getting a little more concerned they won't. But if systemic instability rears its head, will things play out the way they did in 2008, or may we do things differently this time, discount window or other stuff that might change the game? Who knows? That's the value of these weekly discussions, is we can kind of call audibles as we learn more along the way. Here's another one of the questions I wanted to ask you. I was having a conversation with Nick Jurley, who spoke at our recent conference, and Lance, you were there. And I was talking with him yesterday, and he said, he's like, even if the Fed is forced to pivot, he's like, I know people say that's going to, if they pivot before inflation's resolved, then that's going to be inflationary. And he said, yeah, but I just don't see that manifesting in the real world. He's like, I just see the deflationary trends, the disinflation trends that are being pulled by deflationary impulses. And Nick spends a lot of time looking at housing, as you know. He's like, I just don't see that getting reversed, even if Fed policy shifts here, right? He's like, because to your point, it went into, QE went into asset prices, like financial asset prices, but it didn't go in so much to the real economy. We didn't see the crazy inflation and cost of living spike until we did $5 trillion worth of fiscal stimulus alongside the monetary stimulus, right? So my question to you, Lance, is like, even if the Fed pivots at some point because it's getting worried about systemic instability or whatever, will we see the CPI rush back up, back to 8% or so, or could the Fed step in and do QE, but could we still see asset prices, housing, all the things that we're talking about, layoffs, all that, could all that stuff still continue along despite a Fed reversal?
No, so that's exactly what will happen, actually. And again, I agree with Nick on this. And I think that the people have been saying that, if the Fed reverses course, inflation will go through. I think they're dead wrong. Because if, again, let's go back to just a bit of just, logic for a moment. Okay, we have inflation, and we know why we have inflation. And so that's because of what you just said. Now, QE, what the Fed did in 2020 did not cause inflation. Because again, all that does is flow into financial assets, and that boosts the wealth of the top 10% of households. The bottom 80%, kind of just live paycheck to paycheck. It was, to your point, what caused the inflation was twofold. One, it was shutting down the economy, so you had no demand, and then $5 trillion worth of direct checks to households. You gave people money to spend. And that bottom 80%,
right. And we had supply shortages in a lot of things.
Right. So they're going to run out and buy whatever they can buy with, because all of a sudden they've got money that they didn't have before. It's like, woo, party day. Let's go buy some beer and a lawnmower. And so they went out and bought stuff that we couldn't manufacture, right? But that's all reversed now. Now we've got inventory builds, Nike, Target, Walmart, all talking about inventory builds, right? Now we have too much inventory, not enough demand, which is deflationary. So to Nick's point, and he's got the right idea, if the Fed tomorrow came out and said, hey, no more rate hikes, and we're doing they're gonna have to make it bigger, so it can't be 120. We're gonna have to do 240 billion a month in QE. Now, immediately you would think that, man, asset prices are going to just take off to the moon. I need to go buy stocks tomorrow. No, you won't, because when the Fed makes that announcement, you're going to be in the middle of a financial event of some sort. So something will have broken in the markets. Asset prices will be plummeting because asset prices are going to be trying to adjust for this financial event, which is going to crush earnings. It's going to crush corporate profits. Those are going to come down. Prices have to come down. And the Fed's going to be stepping in to try to stop that decline. And they'll do that in twofold. One, they'll drop interest rates to zero. And when they drop the Fed funds rate back to zero and start doing 240 billion a month in QE, when those two kind of collide at that point, that's when you want to start buying stocks. But in the midst of that, and just go back to March of 2020, in the middle of that decline was where they announced, QE, and they announced the cutting rates. They cut rates before. But the market still fell for a few more days before it finally bottomed and people kind of figured it out, right? So, that's what's going to happen here. And deflation will be your issue at that point, not inflation. Because again, when you have that financial event, you're going to be bringing the economy to grinding to a halt. You're going to be in a deep recession, financial crisis, not financial crisis. When I say financial crisis, extract 2008 for a moment, just a financial event. But it'll be something that freezes up the economic activity. So deflation will be a much bigger problem at that point. And that's what the Fed's going to be reversing course, trying to bail out. Okay.
And is it safe to say that if things play out the way that you just think they may, that we can say inflation's not really going to become a problem again until there's fiscal stimulus, substantial fiscal stimulus?
Right.
Okay.
So yeah, if you do another $5 trillion, now look, and let's roll this forward. Okay. So let's say we have another financial event. We have a big, deep recession, right? Layoffs are now surging. Unemployment is now 7 to 8%. And, of course, we've got, at this point, we'll be heading right into a 2024 election, right? So we'll have an election year coming up. So we'll have the Republicans running against whoever the Democrats are going to run for office. And so there's going to be this big challenge about who's going to do the most in terms of socially irresponsible spending. And so they'll start sending checks to households. Now, the difference will be, though, is that we'll send checks to households, but we won't have shut down the economy. So we'll still have production, but we will create a boost to economic activity because of these checks to households. So we'll get some inflation, but it won't be the inflation like we had previously because of shutting down the economy, right? So, there'll be a little difference. My point is that you'll still get inflation through fiscal stimulus because you're giving people, money to people to spend, and they're not going to save it. They're going to spend it, but you won't have the big supply demand gap like you had in 2020 because we won't have shut down the economy, right?
Okay, great. And folks, I realize we're talking about a lot of variables here right now. Maybe we've nailed it. Maybe it plays out the way that Lance and I are talking about. But again, that's why we do these weekly sessions here, is as we get more information and the story unfolds, we'll be, tweaking everything, giving you real-time updates. All right, we are maybe about halfway through the list here, Lance. So I got to keep hacking out here with my machete. Let me just go through some recent data, and let's just talk about it just super briefly in terms of how meaningful you think it is. But I'm going to start calling part of this segment recession watch, right? It just seems like the more data that comes in, the more it is showing that the economy continues to slow. We're continuing to go into recession if we're not already there. So we had two material data releases this week. The PMI was released, and that is showing contraction still. It dropped from 51.8, it went down to 45.7, and at a rough basis, if that number is above 50, the economy is expanding. If it's below, it's contracting. So we're below. This is the lowest reading since June 2020, which is when we were, in the throes of having just shut down the world economy. So again, not a great comparison. If you watch the conference, Lynn Alden talked about the importance of the PMI data. It's actually like one of her favored, if you remember my brown M&M videos, this was Lynn's brown M&M. She looks at the PMI, and what's important to her is not just the reading, but the vector, the direction of the reading. So this is contracting, and it's the momentum is downward, meaning further into contraction, right? It's not rising. It's not below 50, but rising. It's below 50, but descending, right? Which shows to her that, okay, that means the momentum of the economy is to the downside at this point. So there's the PMI, and then there's the University of Michigan inflation expectations. They came out showing that inflation expectations have dropped. This is what you and I have been talking about for a long time, Lance. We've expected disinflation. It looks like consumers are also expecting prices to increase at a slower rate going forward. It was a little bit higher than expected. It was expected at 4.6. It came in at 4.7. So it's not declining as fast as people thought it would, but it is declining. This confirms other surveys. So, it's one data point supported by a number of others. And I think what's important about this is Stephanie Pomboy, during her debate with Grant Williams in our conference, they were sort of talking about whether inflation or deflation or stagflation or disinflation is going to reign from here. And in regards to inflation, this is kind of like what you and I were just saying. She said it's described as an event and then a mindset. And she's like, okay, I've seen the event. I understand why CPI got up to 9 point whatever. But she's like, I don't see it becoming the mindset where consumers are rushing out to spend every dollar they get in their paycheck because they're afraid it's going to buy less the next week.
Right.
And that's the kind of inflation mindset you really get worried about. And that actually creates the continued spiral upwards in inflation. And I think if we look at the data, both in terms of, consumer spending, PMIs, et cetera, but also consumers' reported inflation sentiment, it does sound like that inflation mindset is not kicking in, that people are expecting that things are going to be moderating from here. So two important bits of data that still confirm we seem to be diving into recession. What do you think?
No, I think you're right. And look, Lynn Alden's right. And this is something I've always found humorous about PMI reports in general, is so the PMI report comes out, it's 50.1. Right? And they go, see, economy's still expanding. No, it's not. If I show you a chart where, you've got a stock price at $75 and now it's $50.1, what are you going to tell me about that stock chart? Price is going down, right? I mean, there's something wrong with the stock. It's not the price. There's this magical 50 line of expansion and contraction is so stupid. If the PMI is trending lower, that is telling you the
that's what
economy
matters,
is contracting, right? And that's what Lynn Alden's talking about. It's the trajectory of the trend. So what's important is the trend of the data. Now, look, I'm not talking about a bounce, right? If it's going up and it dips down and then goes back up, that's normal, right? But if it's consistently a lower price or consistently a rising price, well, that's your definition of expansion or contraction within an economy. So don't get wrapped up into that 50-49 crap. It's just not worth paying attention to. But it sounds good for media, right? So, but look, when you take a look at a variety of indicators, and again, whether it's consumer spending or incomes or manufacturing or demand side on the services side, you're seeing weaknesses just show up everywhere. And more importantly, what you're seeing is you're seeing a real contraction in, and again, when you look at sentiment in particular, you're seeing a real contraction, not just on the consumer side, but you're seeing it on corporate executives, you're seeing it with corporate financial officers. I mean, there is a lot of indicators out there that suggest that if we're not in a recession soon, we will definitely be in a recession next year.
All right. So I want to add on to that two other recent conversations I've had, and I feel like I'm doing the greatest hits from the conference, but there were so many.
Yeah.
So at the conference, Matt Taibbi, his whole talk was titled "Smells a Lot Like 2008," and Matt covered the global financial crisis during the 2008-2009 period. That's how he really kind of became a household name, as he was helping the average person. He was decoding all the finance speak and helping the average person understand what caused the breakage and what was being done about it, right? And he said, I'm seeing a lot of the same excesses, from his perch, sort of abuses that a lot of the Wall Street players are doing, and creating a lot of the same instabilities that then led to the breakages that caused the 2008 crisis. I just landed for an interview next week Pedro da Costa, who is a Fed journalist. That's his job. He tracks Fed policy and writes about it. He very famously got ejected from a Fed presser with Janet Yellen, where he basically asked a probing question of her that she clearly didn't want to answer, and ended up never getting invited back to her press conferences, which kind of really, validates the perception that they only want softball questions at their press conferences. But anyways, Pedro, a highly respected journalist in this space, he was just pinging me today saying, hey, this is looking a lot like late 2007 to me. What do you think? And I've just been going over that data, and it really eerily does. If you look at the end of 2007, the markets peaked, the stock markets peaked. They came down a bit into January or so of 2008, to the point where people were beginning to see headlines like, oh gosh, could we be going into a recession at some point? And most of the headlines were like, Fed official says there's no chance we're going into recession, right? Top economists said, nah, there's no way. And then the markets, so they had a bit of a sell-off. They then had a 50% retracement early in 2028, where everybody was saying, okay, see, that was just a little wiggle, right? We're back off to new highs. And then the bottom fell out.
Well, right? You need a little more color here. You're missing a few important points.
Okay, Adam.
You're absolutely right. No, you're absolutely right. And I've been running this chart now for the last couple of months about the 2008 analog. So if you take a look at the market in 2008 versus today, they're an exact overlay. And so, so now let's go back to,
and that's where I was trying to go. So I'm glad you went there. It's very similar to what we're seeing right now in the markets.
Yeah, and that's this is market. And again, I hate analogs. They are the worst thing ever. You should never pay attention to an analog, because this time is different than last time. But what's eerily weird about this one is that it's tracking exactly the same path. I mean, it's almost a perfect overlay. So to your point, right, we rallied into January, February, March, sold off. That was where Bear Stearns failed. And we had to bail out Bear Stearns. Well, Bear Stearns got sold to JP Morgan. It was a bailout for $2 a share. Then the markets rallied to all-time highs. So that left shoulder of a head and shoulders pattern was formed in early 2008. Then we rallied to new highs, sell off, rally back, form a right shoulder, fell, break that. And now we're moving into July, August, and late kind of August-ish. And we rally back, test the neckline, fail, and then that was where we had Lehman.
Right.
And so the point is where we are right now is that we have already tested and failed that head and shoulders pattern. We are now at the low just before we have a counter trend rally that was the setup for the Lehman event. So if we're going to continue to track this analog, then sometime between October and December, we're going to have a rally that'll probably take us mid-October-ish to late October. And then November, December, we'll have whatever financial event we're going to have. And that will cause that next leg down in the financial markets. But, to your point, it's a really great analog to what's happening. The only thing we're missing right now is Lehman.
Okay. And great. And one other element I want to put in there too is housing. It's very similar to what's happening in the housing market, right? I mean, it hit its peak in kind of fall 2007. And then, there was a long prolonged period where, it began softening, but there was a lot of debate about this thing. It's like the Titanic. This ship will never sink. Don't worry about it, right? And it wasn't really until 2008 where all of a sudden, the wheels started coming off. And then, of course, after Lehman, it was off to the races in terms of how far it was going down.
Yeah, and I totally forgot. I totally forgot right now. Back in 2008, there was a hurricane. So the weekend that Lehman was pushed into bankruptcy, so that was announced on Saturday, September. Don't quote me on my date, but I believe around September the 19th of 2008 was where Lehman was announced that Lehman was going into bankruptcy. Well, that Friday, Hurricane Ike made landfall in Houston. And so I'm bunkered down in an apartment in the middle of Hurricane Ike, and we just had Hurricane Ian over the weekend hit Florida. So, similarities, I don't know.
Analogs are crazy.
Ian, I mean, just a little too weird for me. So,
okay. Yeah. And look, I'm not trying to use the tape as a star chart to say, okay, well, on this date, there's going to be some Lehman moment. What I'm saying is looking back at that, it's to a lot of people who lived through it. They're saying, Jesus, this really feels similar.
It does. It does. And again, the one thing, and again, this is why again, talking about it's fine. I think the chart is very interesting. And again, I hate analogs because, by the way, this analog to 2008, it also has a very similar overlay to the dot-com crash in 2000 and even the 1973-74 bear market. They're tracking all the same right now. So I kind of run this chart of historical bear markets. And Bob Farrell had a great saying once. He said, Bob Farrell, one of the famous technicians, he has 10 rules. And if you follow his 10 rules, pretty much he'll keep you out of trouble. One of his rules is that bear markets have three phases. And we talked about the Revenant, right? So you have an initial down, you have a reflex rally. That's where the bear goes away. And then the bear comes back and mauls you to death, right? So, so the point is that bear markets all act in a similar manner. And the bear market we're in today is acting very similarly to what we saw in previous bear markets. Again, I want to drive home, though, that every market is different. So at any moment, these analogs can detach from one another, right? This market could take off or it could go straight down. I mean, it could break that pattern for one reason or another. So again, to your point, Adam, it's not a star chart. Don't go bet your portfolio that this analog is going to keep holding up, right? Because that'll get you in trouble more than anything else. But it's a good precedent to say, look, there are a lot of similarities that could turn out exactly similar to what we've seen previously. History does rhyme. And we have a tremendous amount of debt. We've got a surging dollar. We've got surging interest rates. There's and Adam, you and I have talked about before about, using the example of margin debt. You have like a tanker full of gasoline and, it's all fine until somebody drops a match into it.
Yeah.
Problem, right? So we've got all these catalysts out there, right? And so the debt is the fuel. We've got so much debt everywhere in the market, and you've got all these matches that are laying around, right? Interest rates, the dollar, all the, everything, consumer sentiment, and all it takes is one of them to go off and trigger a whole kind of sequence of events through the market, and that's the big risk. And we just don't know what triggers it.
Yeah, exactly. And again, to your caution about, look, don't use the tape as a star chart to exactly what's going to happen. I look at it more as sort of like a formation in football or in a sports team where you're like, okay, when they go in this formation, they tend to run this play. Doesn't mean they're going to run it, but we should be prepared that this is probably the most probable thing they're going to do, right? So that's how we should position on the field. Okay, and taking that analogy a little bit further, so we talk about the threat of the match, right? And it could be a Lehman type moment, right? Where it could be just something that nobody saw coming, right? And I think what just happened in the UK is a good example of one that could have been, and who knows, maybe it will be. Maybe when the history books are written, this has been a match that has lit some fuse somewhere that blows up in a bit. But there are two things that happened this week I just wanted to flag. We had the apparent sabotage of both Pipeline 1 and Nord Stream Pipeline 1 and Pipeline 2, which honestly reads like out of a Tom Clancy novel. It's one of those things that makes for a great movie, but you don't think would ever really happen in real life, but looks like it might have just happened, right? That has massive implications, right?
Yeah, they said that it took an equivalent of 500 tons of TNT, something crazy like that to blow up those two pipelines, because those are super thick pipelines to start with, wall wise, those pipelines are very thick because of the pressure on the water. Then they're wrapped in and they're encased in big sheaths of concrete. So to impact those enough to cause leaks in both those pipelines was an enormous explosion. So that's pretty crazy. I mean, to your point, it's kind of crazy how this happened.
It's just insane, really, when you think about it, right? And the implications, I mean, just on the energy side alone and the geopolitical side, they're mind-boggling to contemplate. So that just happened this week. And then just over the past 24 hours, Russia said, hey, the 4 regions we've annexed through our incursion in Ukraine, they're now ours forever, right? No ifs, ands, or buts. Not, we're not open to negotiation on any of this. This is just ours. It's now Russia, right?
Yeah, my son used to do that to me.
Yeah, but my point is the ante is getting upped here on the world stage of the white, black, and gray swans that are all circling here. They're multiplying at this point. So I guess to use your analogy, it's just like there are a lot more matches getting lit around our swimming pool filled with gasoline. And that just obviously increases the odds that one of them could turn into that Lehman type moment that just causes the whole thing to cascade down. Not saying it will, but just saying, man, actually, it definitely seems like the unexpecteds are multiplying.
Yeah, well, no. See, here's the thing, though. And I don't disagree with you, but I think it's a little finer point needs. So, for instance, when Bear Stearns failed in 2008, there was clearly something wrong with the whole adjustable rate mortgage market. That was clear that stuff was starting to blow up, but Ben Bernanke was going, "Oh, don't worry about it. Subprime's contained." Well, it wasn't. And, this stuff kept deteriorating. But Bear Stearns was that moment, right? That signaled that a problem was starting, but it wasn't the problem, right? The markets priced that in pretty quickly, and we moved on to new highs in the markets right after that. Bank of England, that's not the problem. It's a symptom of the problem, but it's not. We're not going to look back and go, Bank of England was the problem. Bank of England is not Lehman. Bank of England is Bear Stearns. And what I mean by this is that the event that causes the financial, and this is always the case, right? So 2020 as a good example. In September of 2019, I wrote an article. I said, recession alarms are going off everywhere. The NFIB is dropping like a rock. You take a look at all the NFIB indicators, which are the small business indicators. They were all screaming a recession was coming. You had the Federal Reserve bailing out hedge funds through reverse repo. Clearly something wrong in the markets, at that point. Interest rates are already back at 0, right? The Fed had already cut rates. And clearly something was wrong, right? But the markets kept going up, right? In February, we were at all-time highs on the markets. And then like that, pandemic hits, we shut down the economy, market loses 35%. My point about this is that all these symptoms that you're talking about, all these matches, the market prices those in. Those won't be the match that lights the tank. It'll be something that that the markets don't know about. And it's always the case. It's always this exogenous event that nobody's expecting, like forcing Lehman into bankruptcy on a Saturday, right? Nobody expected that to happen. And that's what caused the markets to buckle immediately after that. The big chunk, big decline in the markets as all of a sudden this wake up event occurs. So the event that breaks the markets will be something that we're not talking about. It won't be Russia. It won't be pipelines. It won't be, Bank of England. It won't be whatever we think it is, because whatever we're talking about, the markets, the reason we're talking about it is because it was in the news, right? And
and that's all I'm saying, which is
the market's pricing this in.
The number of things that we weren't thinking about yesterday are multiplying here, right? I don't think anybody had sabotage of the Nord Stream gas pipelines on their bingo cards. It was all, these were an asset that Russia and Europe are in a cat and mouse game of who's going to send what through it. But nobody thought that either party would say, well, let's just blow the damn thing up, right? So my point is just the number of black swans, the things that we're not thinking about right now, seem to be multiplying out there. And one of them might actually hit the target or ignite the landmine, right?
Well, actually, what I think it'll be is that one of these things will cause something else to happen.
Right.
That lights the tanker. right?
Right. Well, and like here's a great example: the Nord Stream pipeline. Right. In theory, if that's deemed an attack by Russia on Europe, the countries that depend on it, then
right.
then that could be deemed as an act of war. And as a NATO signatory, we might need to support Europe in retaliating against Russia for that. And then, I mean, who knows what could happen, but the World War III could ensue, and that just takes, right. Hopefully that doesn't happen, right? But the point is that
would
to
be
your
bad.
point, one domino falls, one archduke gets shot in a small, country no one's heard of, and then all of a sudden the world's at war, or the entire chessboard's been upturned, right?
Yeah. Let's hope that doesn't happen.
Not trying to sell fear here, folks. I'm just saying uncertainty doesn't help the current situation, and uncertainty is dialing up. Okay, let's move on here. Okay, so there's a couple of things. I've got a couple of things that'll be more fun to talk about that people have asked us to. Before I get there, I want to do a little mini rant or diatribe, or whatever we're calling these things now. So Hurricane Ian has been devastating to parts of Florida, and I should say first, our hearts and sympathies go out to our listeners in that part of the world. Hope everybody is staying safe. You and your families made it through, but the initial reports on lives lost is terrible, and the damage. This is the second most expensive storm since Andrew, I think, is the one that holds the record, and of course they haven't finished the tallying yet. But I'm already seeing headlines that say, "Oh, this is going to be, the rebuilding effort's going to be a great stimulus to the economy." Right? I see you shaking your head here, but I'm always confounded by people that think this way.
Yeah. So it's called the broken window theory, right? So the broken window theory is that, a glazier a baker is in his house, and somebody breaks his window. So he goes to the glazier to get a new window. So he swaps bread with the glazier to get the window, but the glazier has to go out and get the commodities that he needs to make the glass in the house. And so the theory is, this broken window theory is that it multiplies through the economy. So if I have to just replace a window, it's not just replacing a window, it provides all this work and income to all these other people just to replace this one pane of glass. Okay.
So let's go out and break all our windows and stimulate the economy, right?
Yeah. Exactly. So my example is better, which is, let's go blow up a city, right? Let's just go nuke Chicago. And just rebuild it, right? And if the theory worked, right, why not just go blow up cities and then rebuild them, and then we'll have this really great economy? It's a stupid theory, because all you're doing is rebuilding what you destroyed. And so you're not creating new activity. All you're doing is replacing what you destroyed. And so, yes.
Right. And spending reserves to replace productivity that you had. There's no incremental productivity. You're just net out your reserves.
Exactly. And so basically you're dragging forward future consumption, because all the money I would have spent in the future on buying a new car or buying, new products or an Xbox or whatever, don't have it, because I've now had to spend it to replace everything in my house. And yes, I know people get insurance money. It's all the same thing, because all you're doing is replacing everything that was lost. So yes, you will get a short-term economic bump from the hurricane. It's a terrible way to get an economic bump. And I've been through 5 hurricanes in my lifetime. They're never fun. I mean, my house was flooded 3 times when I was growing up on the coast. So, going through hurricanes is a terrible thing. But, you don't come out of these things going, oh man, I'm so much better off than I was before, because it actually winds up costing you more. Whatever you get insurance wise to replace your house, you wind up spending more money, because it never covers what it is. So you're going to be out future reserves to just get back on your feet. We had Harvey here in Houston back in 2017, and there are still people today still trying to get back on their feet, from even that hurricane, right? Because they lost everything. They didn't have flood insurance, or they had insurance and it didn't cover everything that they needed to have covered. And, it's just, it devastates people for a long time when you have that kind of damage. So this whole theory that this is going to be an economic windfall is complete hooky.
Yeah. And this is going to be a good segue to our next topic. And it's basically reinforcing what you said earlier, Lance, about, something makes for a great headline, but it doesn't necessarily make it true, right? And so the average casual investor who's just reacting to headlines is oftentimes using, bad inputs to make their investing decision, right? All right. So last week we did not have time to get to the discussion that I was hoping to have about the young guy who's about 18 years old from South Africa, who called and asked me about my advice to a guy his age who's interested in finance and business, and what do I wish I had known starting out at his age. And given everything that's gone on this week, I have not had a chance to put this into any sort of intelligent progression. And so, folks, this is not the be-all end-all financial advice for younger people. I think that deserves its own standalone webinar, which I will commit to bringing to you with Lance and his team if they are so inclined to help me produce it.
We've already talked about doing this.
Okay, great. But we can at least kick things off here, right? And so what I thought I'd do is I thought I would read some of the questions that he asked me, and I'll tell you what my answers to him were, and then you can tell me what you would have said, because I'm sure it'd be even better than my thoughts. All right. This question was, what would you recommend to a young guy who's starting university and has a genuine interest to learn about investments and business? So this is what I told him. I basically said, do 4 things. The first is absorb. That means your goal here is just to get understanding, just to get smarter. So this is, you've got access to great professors, take their classes, meet with them afterwards, pick their brains, read the right books, watch a ton of videos like what Wealthion offers, but there's many other theirs online as well. You get a massive, great exposure and education for free just on YouTube alone. And then, be fearless about scheduling informational interviews. If people are doing things that interest you, that you want to learn more about, take them out for coffee, call them up on the phone, ask if they take 50 minutes of their time to, enlighten you. And I'll tell you, people love to talk about themselves, and they love to reward people who are interested in what they do, right? So you'll be amazed at how many people you reach out to and with a cold call who are willing to help out a young person. So that's number 1, absorb. Number 2 is explore. Your goal here is just to get practical experience and to start developing some skills that are useful and eventually marketable. And this is basically just be fearless about trying the things that interest you. Go, apprentice under somebody who's doing something you like. Go shadow people. When you're young, you've got a massive advantage where you can trade the currency of your time and energy for experience, and you don't need money in that equation, right? You can just say, look, I'm a young kid. I'm happy to sleep on a couch. I just want to learn, and I'll give you my sweat and brain power for free, Mr. Mentor, if you just give me, a view into what you do, right? The third is to fail and retry, right? Your goal here is to develop the ability to overcome adversity and develop a mindset of self-confidence that, if I don't know something, I can go pursue it and figure it out along the way. And if I fail, I can course correct and turn a failure into a success. And way too many people, but certainly way too many kids are afraid of failure. And so they don't try and they don't gain the experience. And they end up basically making much more conservative choices in life versus getting on a path to success, which by definition has to have some adversity on it to overcome. So early on in your life, you want to get that experience of throwing yourself into something, having to learn how to react to what gets tossed your way, and most importantly, realizing that failure isn't a death sentence, and oftentimes it's the best educator that's out there. And then last, and then I'll let you talk here, Lance, keep in mind the following equation, that information plus experience equals mastery. And mastery is what you use to create value. And value determines your ability to do and to get paid what you want, right? So, everything that you should be doing in that progression I laid out should be for the goal of getting as much information in your brain as you can, combining that as much experience as you can, because that is what you are going to use across the arc of your career to command the compensation and the opportunities that you want. That was my answer to that question. I'm curious what yours would have been.
No, I think you hit a lot of the right things. One, I suggest to everybody that I talk to is, get a mentor, right? Somebody that you admire, you respect, that has a proven success track record, right? I mean, we know a lot of people in our lives, and a lot of people are not successful, and they're not successful for a lot of reasons. But if you can find somebody that has become a real success in whatever field they're in, and again, to your point, get them as a mentor, right? Because again, people that are successful, they don't mind teaching what they know, because it's flattering to them that you want them to be your mentor. So again, take them out for coffee, take them out for lunch, build that relationship over time, and listen to what they have to tell you, and don't talk a lot. Just ask them questions and let them talk, and listen to what they have to say. And that was one of the best things I ever did in my life. Was I found a gentleman that was very successful. And again, it doesn't have to be in your field either. It doesn't have to be, I want to be in the finance industry, so I'm going to find a finance industry guy. My mentor ran restaurants, and great guy, super smart, taught me tons of things I never knew, right? And helped guide me in the right direction. Business is business at the end of the day. Doesn't matter what the business is, all business works the same way. And so somebody that can keep you out of those big pitfalls that destroy you, will get you to where you want to go in success. From an investing standpoint, we've talked about this before. If you want to start learning how to invest at 18, highly encourage it. I think it's great. Start by buying just a single S&P 500 ETF. Learn how the car works before you try to break it down into parts and rebuild it, right? So, we've talked about this before. If I gave you a garage full of parts and you've never seen a car before, you have no idea what to do with the parts. So this is like trying to buy a bunch of stocks in the index, have no idea how the index works. What makes it go up? What makes it go down? What events cause what? And once you learn that, once you learn the rhythm and the movement of the market, then you can start breaking this down and trying to find, pick the stocks that are going to make you more money over time. When it comes to things like, finding out what you want to do in life, I encourage people to do two things. One, when you're trying to pick, you're 18, right? So you're trying to figure out what you want to do with your life, right? So this is important. Too often, we just go, hey, I'm going to go to college. I'm going to get a degree, any degree, whatever I can get, just to get out of college and have that piece of paper. Don't do that. It's a waste of money. If you're going to go to college to get a degree in something that people want to have. And so, ask the college, go to the counselor at the college and say, what are your top 10 most requested degrees by employers that come to recruit on campus? And they'll tell you. They'll say it's, engineering, math, whatever it is.
Yeah, they have the numbers. The Career Center actually has the data. Yeah,
exactly. And so if none of those appeal, now look, I want to tell you this: you need to do something in your life that you enjoy doing, right? Because there's an old saying that if you do what you love, you'll never work a day in your life. And that's true. I love what I do. I work 18-hour days every day. I work Saturdays, I work weekends, but it's not work because I love what I do. I enjoy working with people. I enjoy the market madness. I enjoy all this stuff, although it's trying it sometimes, but I love what I do and I'm passionate about it. So, it may be something that doesn't make a lot of money, but if you're okay with that and you're passionate about doing that, you'll be happy, right? You may not be wealthy, but you'll be happy. And there's different types of wealth. We get too tied up because this is all we see on Instagram every day is about having all this wealth. We need to drive Ferraris and live in multi-million-dollar houses. And that's what makes happiness. And that's not what makes happiness. Money does not make happiness. If you want to be happy, do what you love, marry a partner that loves you for who you are and is a partner, not just a spouse. Those are two very different things. And if you find a partner in life that will support you and have, your children, your family, those are true wealth. That's what builds wealth in your life. Faith, family, that is what wealth truly is. And if you can build faith and build family, the wealth will follow. And it will come to you if you do the right thing. Faith will have you do the right things in life. Family will encourage you to do the right things in life because you will work to support your family. And in order to do that, you have to do what is successful, and you have to follow the rules of success in order to build that wealth, in order to support your family, so the wealth will come. And so if you follow the rules, it's not real difficult to be successful. You just have to apply yourself. And then, Adam, to your point, the most critical factor that keeps people from being successful in life is not taking the risk. And that's it. In order to build anything, if you want to just have an income, go get a job. You will have income, you will have stability. And if you're happy with that and that fulfills you, no, there's nothing wrong with that at all, right? People poo-poo electricians and plumbers and blue collar workers all the time, but if that makes you happy, that's all that matters. It doesn't matter what other people think. Again, wealth is family, wealth is faith, wealth is what makes that all coalesce together. But if you want to build real wealth, and I mean, now we're talking the money side of this, you've got to step out on that curve. And the difference is Adam, he's an electrician. He's a good electrician, but he doesn't want the responsibility of running the business. So he will earn an income for the rest of his life because he's an electrician. Everybody needs an electrician always and forever. If you want your lights to work, you need Adam. I, on the other hand, I want to take the risk. I build the company that Adam works for.
You own the electrical company, yeah.
Right. And so, but I'm willing to take that risk. Now, this is the fallacy that we hear a lot in the markets is that, well, I need to get paid more because, Lance, he's making all this money for owning the company, but he's not sharing that with me. Well, hold on a second here, bucko. Lance over here that owns the company, he's taking all the risk, right? He's taking the risk of bankruptcy. He's taking the risk of loss. If there's a lawsuit, if Adam goes and miswires a house and it catches on fire and kills 4 people, that's not on Adam, that's on me, right? So that's coming back to my company. So I'm taking that risk. I'm paying all the bills. I'm paying the benefits. I'm doing all of that. And I need to make a profit on top of that so I can get paid to support my family. So if you're willing to take that risk and step out on that curve, you can build wealth. But if you take that risk means that you suffer the consequence of failure, and you will fail. There is no successful person in life that hasn't failed at least once. And there's a lot of people that have been bankrupt multiple times before they hit the ball out of the park and built massive fortunes. So you've got to be willing to fail, get back up, and step right back out there on the plate and swing again.
All right. All of that was gold, Lance. And I'm just not even going to worry about the time here. So we're just going to keep plowing on this. We just talked about what our advice would be for folks to do. He did ask, okay, what would be the biggest don'ts that you recommend? You actually more or less touched on my 2. I'll mention them briefly and we'll see if you have any other, Lance. The first one was don't be too cautious. Don't fear early failure. I think both I and you did a good job of hammering that point home. The second one, and this sort of goes back to your point about, do what you love. And I understand that not every 18-year-old knows that yet. And I'm actually going to get to a single test that you can take that dramatically improves your odds of finding the answer to that. We'll talk about that in just a minute. But anyways, the other one on my list here is when I was at business school, I went to Stanford Business School in the late 90s. The most popular class to get into was this Professor McDonald. He just had a ridiculous Rolodex. And he would bring in, if we were going to talk about, Intel as a case study, we'd come in and Andy Grove would be there and we'd get to talk to him about, the decisions he had to make at Intel, right? So we walk in there one day and there's this guy and I'm like, what's my grandfather doing here? Because this guy looked just like my grandfather who had just passed away like the year before. And it took me literally like a couple of seconds to realize, oh my God, that's Warren Buffett. Warren Buffett is here. And this is a class of about 50 people. And Warren Buffett, looks at his watch and says, hey, everybody, I'm Warren Buffett. I got an hour and a half. I'm here for you. What do you want to know? And we just got to ask him questions for an hour and a half. It was amazing. And the answer of his that stuck the most with me, because these are all type A business school guys, what should I do here or there? And he basically said, I would highly encourage you to stop worrying about focusing on the resume, that I've got to do X because it's going to impress somebody down the line who may hire me to do Y, right? He just said, No, just figure out what you do. If nobody paid you any money, but you just love doing it. And to your point, Lance, you said, if you've been able to figure that out, you've kind of won life already. Like, yeah, the money might not come, but every day you wake up excited to do what you're going to do, and you know that you're applying your life to a pursuit that fulfills you. But obviously, if you're doing something you love, your odds for outperformance go up dramatically. And so, interestingly enough, the less you worry about the money and lean into really becoming an expert in something that you're great about, the more likely the money is actually to find you, right? Yeah. And so you've got to be willing to kind of like just ignore what the world is telling you about what's a good job and what's a bad job, and really focus in on, what do I want to sort of make my life's work, and make that your focus. So don't let the resume, don't let the perceptions of others drive you. There's a great learning I took from a psychiatrist friend who said, as part of the normal maturation of a human, is you need to shift from living a life based on others' expectations of you to living a life based on your own expectations of yourself. And the thing is, when we're young, we live according to the expectations of others. What do our parents expect us to do? What do our friends expect us to do? What is society telling us to do? And eventually, to find true happiness and alignment with who we are, we have to determine what's really core to me, and then align our life around that. And this is oftentimes what people have like midlife crises, because they've been following a path based upon what society is telling them is right. And then they're waking up every day saying, I am freaking miserable. Is this all there is to life? So you have to deconstruct that. You have to ignore all those voices and really turn inwards to find out what really, how you're wired, and then design an external plan to go pursue it. So those were my don'ts. How about you?
Don'ts are, don't jump into a partnership with somebody unless you really know who that person is, because when you get into a partnership with somebody, it's the same as being married. And unwinding a partnership is extremely messy in a lot of cases. And, more businesses get completely blown up because of partnerships. So if you're going to start a business, try not to take on partners. A lot of times we do that because it's an easy way to go. I have partners in my business is a good example, but they're guys I've known and worked with, and we have very similar mentalities and very similar outlooks. And, it works, but it's a marriage commitment. So unless you really know the person that you're going to get into bed with, and again, I can talk about this experience. I've had bad partners in life, and it's cost me a lot of money along the way trying to unwind those partnerships. But it's something that you've got to be really, really careful with about who you get married to in business, because it can work out really well. You can have Warren Buffett and Charlie Munger, or it can work out really poorly. And more often than not, it works out pretty poorly.
Got it. All right. Yeah. So basically treat a partnership decision like a marriage decision. It's really somebody that you should know very well and vet. Don't make it the equivalent of getting married after speed dating. Right.
Yeah, exactly.
All right. And then here's the last question. What would your younger self be doing today? Right. If you were 20 years old today, but you could be advising yourself, how would you do it differently? Right. And it looks like you got an answer. Let me give you mine, and then you jump in. And some of mine will be quick because we've already mentioned them. But probably the biggest one that I have is really focused at a young age on self-understanding. And I talked about the importance of this earlier in my earlier answer, so I won't go super into it. But really, like, understanding who you are, creating a vision of what success for yourself could look like. And I don't necessarily mean like I have to have this exact job, but it's like I should be doing this type of work in these types of areas that interest me, right? Coming up with a vision for that, and then beginning to create specific goals off of that. Okay, well, if that's where I want to go at the end, if that's what my destination looks like, what are some of the key experiences, key steps I need to accomplish along the way to get there, and start aligning all your decisions around, okay, is that decision getting me closer to one of those goals, right? Do this around, work, money, what degree you decide you're going to get, relationships that you're going to invest in, et cetera. And know that the plan is going to iterate, right? So don't feel pressure to solve everything at once. Imagine it as a picture that as time goes on, you're just clarifying that picture over time, right? You want to start with something that looks when you squint like maybe kind of what you think. And then as you get better at getting more data and experience, you start refining it and it gets crisper and crisper and crisper. I wrote a book actually about 10 years ago. It's a really small little book called Finding Your Way to Your Authentic Career. And it talks about a progression of exercises and tests and experiences that if you follow, actually will give you a much higher probability of answering the question of what should I do with my life? And I think it benefits anybody, but obviously answering that stuff earlier in life, you get to amortize the value over a much larger period, right? So it has a lot more value for younger people. And what I tell people is, look, if you can't read the book, if you could only do one thing, you should take the Johnson-O'Connor aptitudes test. And I can talk about this at length. I have. If folks are interested, I'll put a link below into both an article I've written about it and an interview I did with the executive director that really helps you understand how the test is run. But long story short, it's a big test. It takes you about 6 hours. They test about 50 different elements. But it's been running for over a century, and they've had over 1 million people go through it. So it is highly, highly statistically correlated. And so you take it and they say, Lance, you look like the 6% of people who took this test got the same scores. And here are the things that they are naturally gifted at that bring them personal fulfillment. And it spits out a list of jobs that you can look at and say, this is what the jobs people who like you tend to succeed in and like. That's not really the important part, though it's helpful, right? It's really more the aptitudes. These are like your personal superpowers that you are just innately wired to do well based upon how you've developed. They're the kind of things that if you do, you are highly likely to outperform other people. But they're also the things that generally tend to give you a lot of personal satisfaction, right? So it's a great way for you to, I call these sort of like compass points. You doesn't necessarily tell you the destination, but they're compass points you can use to navigate to make much better fit decisions in your life. And a good example is if you take this test as like a 17-year-old before you go to college, the odds of you changing your major go down by like 70% because you've made a much better fit decision the first time because you're informed by all this information. What's also interesting too is it tells you what you're not so good at, which is really nice. It's kind of like that, hey, feel free to do this if you want to, but like don't quit your day job if this is your expectation that you're going to be great at this because you're just not that great versus other people. So again, if folks are more interested in that, go check it out. You can go to their website or you can watch the interview that I did. But that is in terms of getting back to my point, which is self-understanding, highly effective tool for that. But it all starts with really developing a very good sense of who you are. Way too many people don't. They just jump into the stream because people are telling them, oh, this is a good industry to work in, or this is a hot job, or my dad did this, so I guess I should do it too. And oftentimes that's a recipe for waking up, a decade or two down the road feeling miserable, right? So self-understanding. The second, as I said earlier, was trade your time and your need to not earn a lot of money to be able to gain experience. It's a total progress accelerator. I mentioned that earlier. Recruit a personal advisory board. So this is just building what you said about getting a mentor, Lance, but really, again, build a board of advisors. Don't just rely on one mentor. Get a bunch of people with different experiences in different areas of business or expertise that you think is interesting. And, ask if you can't talk to them every so often when you're faced with a decision to get their counsel. I guarantee 8 out of 10 people you ask are going to be happy and delighted to do this. The last one is invest early in your life in the following. Assets that cash flow over time. And when you're young and you don't need a lot of cash flow initially, there are investments, particularly on the private side, where you kind of have to unlock the future years of cash flow. There have to be a few years of investment where the investment doesn't pay out. When you're young, you can absorb that no problem. But if you can build these streams of cash flow, by the time you're in your 30s, 40s, when these things are really beginning to kick off, passive cash flow, that's income you don't need to make and that you can then put to other uses. It's a great advantage that if folks aren't planting those seeds early, they don't get that harvest, right? So there's that. Second is invest in your health. Lance, I know you and I have come to this conclusion in our lives. I will say that in my 20s through 30s, I didn't feel like I could invest in my health. I felt like those hours have to be nose to the grindstone working, and my health sacrificed trying to, focus on work. And I began realizing how that put me at jeopardy of actually being there down the road to provide for my family. That like, look, if I get so unhealthy, I drop dead because of stress or, being overweight or, the fact I haven't exercised at all this year, that puts all of my plans in jeopardy. So I need to prioritize my health to be the type of provider that I want to be to my family. Of course, all the other benefits of health, just quality of life and being able to do lots of other stuff and living longer and all that stuff are wonderful, right? So make health a priority early in life. And then the last is relationships. You talked about the importance of a spouse and a partner. When they interview centenarians, people who live to be 100, and you can Google centenarian advice on YouTube, the number one thing that comes out of these people's mouths when they ask, like, okay, you're at the end of your life, what really mattered? It's always the relationships. That's the spice of life. And it's also the relationships that advance you in pursuing your dreams. People have contacts, people have the ability to open doors. So make developing meaningful, valuable relationships really at the top of your list. So that was my set. What else would you add to that, if anything, Lance?
So yeah, I agree with all those, and I think those are all absolutely right. I would also add on that before, investing in cash flow assets is a great idea. Problem is you got to have cash flow to start with.
Yep.
Right. So the first thing that if I could go back in time and go, okay, my younger self, here's what you're going to do.
Buy Apple stock.
Yeah, buy Apple stock, right? If we go back in time, it'd be awesome. No, save 30% of your income right off the top. So whatever you make, put 30% in the bank, live off the rest. Train yourself at a young age to do that, because then what you have to do is start making those decisions. Look, I have to save that 30%. And so that means I can't go buy, the brand new, hot car in the market to impress girls, right? I've got to drive something that gets me from point A to point B. Read the book called Millionaire Next Door. Would be a good start, kind of a start.
Agreed.
But if you, again, you can't invest if you don't have capital. So you can't buy rental properties. You can't invest in the stock market. You can't do things to build wealth for yourself if you're not saving cash flow, right? So second thing is never, ever touch a credit card. Right? People go, oh, you got to have a credit card to build credit. No, you don't. Trust me. If you got cash flow and you got assets, people will lend you money all day long. You will not have a problem getting a loan. So the whole, it's like the National Association of Realtors tells you need to own a home. The banks will tell you got to have a credit card for credit. No, you don't. It's complete falsehood. If you have cash, you have assets, people will love to loan you money. Pay your bills on time. Rent your apartment. Pay your apartment rent on time, pay your utility bills, pay your phone bills. You'll get a loan. With the time that it comes to get a loan, you'll be fine. Particularly if you've got a lot of cash in the bank. So again, buy those, and again, to Adam's point, cash flow assets is great. If I could go back to being 18, 19, 20, 25 years old, I would buy a whole life permanent insurance policy and overfund that. And every 5 years, I'd increase the face value of that policy so I could continue to overfund that policy that grows tax-free. If I would have done that at the age of 25, I'd be retired today because that money just continues to grow tax-free, has a tremendous amount of tax-free benefits, and you can actually use it to buy those cash flow assets that have a higher yield and use that money tax-free to buy those cash flowing assets. So it's got a great leverage capability tied to it as well. We're going to do a podcast on this sometime with you, Adam. We'll talk about how that all works. But, invest in assets. Again, buy an S&P index, fund it on a regular basis, let it grow over time, put that in a Roth, let it grow tax-free. And again, tie that. Again, this is all the wealth building part, but you got to have cash flow first. So again, living your life in a mean that allows you to save that 30 to 40% of your income, and don't keep adjusting your lifestyle up as you make more money and as you build success. Build your wealth first, and then once you have your wealth built and once you've got that security put in place, then go out and start splurging on the things in life that you want to spend on. And again, all that comes along. You can't do any of that if you don't have a good partner. You can't do that if you're taking on too many liabilities. Buying houses that are too big, too expensive for you to live in, buying fast cars. It's all great, fine and dandy. And again, but you pay a price for that down the road. And this is why 80% of Americans, have less than $500 in the bank.
Yeah, and I'll underscore that, Lance, by just saying as an example,
And it sounds really
if folks are sitting here watching you and I and saying, for whatever reason, I think Lance and Adam are good guys to listen to about wealth building. The key thing that all the millionaires and the millionaire next door shared was the sense of frugality, right? That really sort of is the pillar that their wealth accumulation was built off of. But for me personally, and I believe too for you personally, Lance, I lived extremely frugally once I left home for college, and then many years after that. Always follow the pay myself first rule, which was, to your point, put 30% or more if you can of what you earn into savings, then figure out how to pay your bills. And you have to get real creative about cost footprint minimization. So, talking about living in the apartment with, way too many people and having just a mattress in the corner to sleep on because you're not investing in the cool, sexy things right now, right. But you're not getting into debt, and you're beginning to build a savings base that you can use as the foundation to build the rest of your financial resilience off of. I believe you did the same thing too. I remember you talking about sleeping in your car for a long time to save money, right?
I did. Well, look, and it's interesting. I saw a great video the other day. A guy was talking about, he says, if you want to be successful, learn how to manage money. And he goes, and he points to, he picks up a cup of coffee, and he's at a hotel, at a hotel convention, right? He holds up a cup of coffee, says, see this? It's a free cup of coffee because the hotel was giving out the coffee for free. And he says, sir, hold up your coffee. And the guy holds up a Starbucks coffee. He goes, that's a $5 cup of coffee. He said, so don't come whining to me that you don't get paid enough on your job. Don't come whining to me that you're not earning enough to live when you're walking around with $1,000 cell phone and a $5 cup of coffee. Make better decisions with your money, and money won't be a problem. And I was like, that is a brilliant statement, because again, consumerism. And look, how does Facebook make their money, right? Advertising. How does TikTok make their money? Advertising. How does Twitter make their money? Advertising, right? And so if advertising didn't work, these companies wouldn't be in business for very long, because if they're selling you a product and you're running out and buying, $1,400 iPhones and $5 cups of coffee and $200 pair of shoes, and you're making 30 grand a year, you need to really evaluate, kind of where you're spending money. And again, this is why you go back to saying, once you strip out 30% of your income right at the top after taxes, and you're going, okay, I make, $2,000 a month. I'm going to take 30% of my bring home, put that in the bank. I'm going to live on the balance. All of a sudden it's like, okay, I'm buying a flip phone because that's all I can afford right now. And you have to start making better decisions. But, we all want to whine about the fact we don't make enough money, but then nobody looks at the fact about what you're spending all that money on.
Exactly. It's about the expense management side. And exactly. Look, we could do an entire, webinar off of that. Okay, so folks, I got to begin to wrap it up here. Thanks for hanging with us this long. What Lance and I just did really was more or less off the top of our heads. We are still very committed to doing a full-blown webinar on, basically financial future building for kids, or at least for younger generations, because I don't want to exclude people that are in their 20s. If you are interested in us doing that, please let us know in the comments section below. Lance, you also talked about the whole life insurance product there that sometimes people call, what do they call that, like private banking or infinite banking or something. There's a number of terms around that. If folks are interested in hearing more about that, let us know too, and if there's enough folks who want to hear that, we'll bump that up in the priority list as well. But I think we should do an actual webinar around that as well too. All right, and just to start to land the plane here, folks, I mentioned a lot, I referenced a lot of the speakers that spoke at the previous Wealthion conference. Two things about that. One, if you watch the conference and for some reason you haven't received the replay videos yet, they were sent to everybody, but I've been getting probably 10 or so people have reached out and said, I can't find it in my inbox. Where are they? Maybe a spam filter got it, who knows what. But if you don't have it yet, just email it at us at info@wealthion.com. We'll send you the replay videos. Just make sure you email us from the same email you used to register for the conference. That way we can confirm that you were indeed a registrant. If you didn't watch the conference, but you would like to, good news is everything was recorded. All the presentations, all the live Q&A, all the interactive sessions with the financial advisors like Lance. So you can purchase those replay videos if you like. Just go to wealthion.com/conference and you can buy the replay videos there. Lance, thanks for hanging with me. This was a long one, but we could have kept on going even more. Folks, if you enjoy these, and if you don't hold it against us that we went so long this time around, please help support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. A quick reminder that we do these to help educate people, but information by itself doesn't have value. You have to put it into action. We highly recommend you work with a professional financial advisor to do that, especially in this environment. If you don't have a good one or want a second opinion from one that does understand all the macro issues we talked today, maybe even Lance and his team themselves, just go to wealthion.com, fill out the short form there, and you can have a free consultation with those guys. Doesn't cost you anything. There's no commitments. It's just a conversation between you and a smart advisor. They'll tell you what they think you should do, and you can determine what you want to do with that information. All right, Lance, look, thanks for hanging with me for another week. Things are getting real interesting. Whatever happens from here, we will be talking about it and hopefully deconstructing and demystifying it for folks here next week. Everybody else, thanks so much for watching.